Ladies and gentlemen, the Governor and Chairman of the Monetary Board of the Bangko Sentral ng Pilipinas, Dr. Benjamin E. Diokno. Sir.
It is my pleasure to welcome and introduce our keynote speaker, Professor Lawrence H. Summers. Professor Summers is one economist that anyone doing policy and research on this pandemic must listen to. He is both a respected academic and a crisis-tested senior policy maker. His work spanned four main areas: macroeconomics, financial economics, public economics, and labor economics. He is also known for the Summers Doctrine, which is a policy-making approach in the face of financial crisis that combines microeconomic laissez-faire with macroeconomic activism. He is President Emeritus of Harvard University, a professor at Harvard's Kennedy School of Government, a former U.S. Treasury Secretary, and a former chief economist of the World Bank. His tenure at the U.S. Treasury coincided with the longest period of sustained economic growth in U.S. history. Professor Summers has played a key role in addressing every major financial crisis for the last 2 decades. Great to have you with us, Professor Summers. You have the floor.
You for the energy and the creativity that your bank has brought to sponsoring this conference, and for everything that you have done in the Philippines. I have long followed the activities of the Bretton Woods Committee. I believe the kind of forum that the Reinventing Bretton Woods Committee represents is something that is profoundly important. The world keeps changing, and an architecture that was appropriate 75 years ago surely is no longer appropriate today. And all of us involved in the global financial system need to constantly be checking our thinking against the evolution of markets, against the evolution of the global economy. And certainly this recent 15-year period with the global financial crisis, with COVID, with the dramatic changes brought about by technology, are a period when such rethinking is enormously important. What I thought I would do this morning is reflect on the secular stagnation ideas that I have been talking about for some years, talk about my conceptualization of the central economic challenge as, at many times and places, been one that is about savings absorption rather than about demand containment. And then reflect on the current moment in the United States and perhaps the current moment in some other places and the central banking challenge that it presents. And then finally, talk about the medium-term central banking challenges, which I think may well look more like the central banking challenges of 3 or 4 years ago than like the current central banking challenges. The most salient financial fact about the global economy over the last dozen years is the dramatic decline in global real interest rates that has become apparent for a generation. As we speak, the 10-year index bond has a significantly negative yield in essentially all major countries, as does market measures of forward real interest rates out 5 to 10 years beyond the cyclical frequency and beyond the impact of COVID. This substantial decline in real interest rates is the culmination of a trend that can be dated on some views since the mid-90s, on other views since the early 1980s. It is a trend that has been present in almost every major country, and it is a trend that was affected but not fundamentally altered by the 2008 financial crisis. Indeed, extrapolations of the trend from data prior to the financial crisis do a good job of tracking the current level of real interest rates. So there can be very little question that the real interest rate over horizons beyond anything much influenced by nominal rigidities has declined quite substantially. Second observation, considerable controversy attends the question of the reasons why. There are two broad paradigms for thinking about the reasons why real interest rates have trended downwards for 25 years, and they are in a sense complementary. One paradigm sees the level of safe interest rates as being primarily determined by the supply of such assets and by the risk premium separating returns on safe assets and returns on risky assets, such as corporate equities. An alternative paradigm that I see as representing the larger explanation sees the safe interest rate, indeed sees rates of return on all assets, as being determined by the interaction of savings and investment propensities on one tail, on another, the supply and demand for loanable funds, on another, the level of desired wealth accumulation versus the level of desired capital investment. I believe that the latter paradigm is the more important paradigm in understanding movements in real interest rates. Perhaps the clearest evidence of that comes from the fact that it appears that required rates of return on all assets have declined quite substantially over this period. Perhaps one need only look at the level of equity markets, the multiples associated with equities, the multiples associated with real estate, the diminution rather substantially in credit spreads, to see that it is a far broader phenomenon that goes beyond the unique case of safe assets. That does not mean that the kind of asset supply effects stressed by proponents of the safety trap theories, such as Ricardo Caballero, are without any power in explaining what happens. But I do believe that thinking in terms of the broad supply of savings and the broad demand for investment affecting overall rates of return is the right way of thinking about what is happening in our economies. Third observation, the decline in investment propensities and increase in savings propensities are easily explained by large structural factors that we can all observe. These include demographic change, where a much slower growing labor force almost everywhere leads to a reduction in the desired share of GDP devoted to investment, and as populations age, some propensity towards increased saving. They include the substantial increases in inequality that have been observed in most countries, that have reduced, that have raised savings propensities as the marginal propensity to consume of those with high incomes and those in receipt of corporate profits surely substantially exceed the magnitude of the decline, surely exceed those of poorer individuals, leading to a higher propensity to save. They include the technological transformations in our economy that have made the relative price of capital goods much lower than previously, meaning that a given level of capital to create absorbs less saving than it once did. They include a wide range of structural economic changes that have led to less creation of shopping malls because of e-commerce, greatly reduced levels of office space because of the availability of information technology-based filing systems on the cloud, and many other examples. Indeed, it is indicative of our era that the most dynamic and progressive companies like Apple and Google, find themselves with the major business problem of what to do with all the cash that they are generating and choose to return it to their shareholders. A world in which the most profitable and dynamic companies can't use all the cash they are generating is a world in which there are important issues of supply of savings relative to the demand for investment. So I believe that structural changes in the supply of savings relative to the demand for investment have created a situation in which markets clear at substantially lower interest rates than would once have been the case. Notice that this view fits the broad surprises of the pre-COVID global economy relative to what was expected in the middle of the last decade. We have had substantially lower real interest rates. We have had substantially larger government budget deficits. So the accelerants of economic growth have been more rapid than would have been expected. And yet, both real GDP growth and inflation prior to COVID fell far short of their targets. Notice also that during this period, even as growth was disappointing, tremendous bull markets were observed in capital assets, particularly in the United States, as multiples increased, connecting prices and earnings, or real estate values and rents. This is exactly what one would expect if one saw a structural change in the savings propensity and reduction in the investment propensity. A declining level of aggregate demand would mean that even with more stimulus to aggregate demand, one would observe in product and labor markets the consequences of an adverse aggregate demand shock. One would observe in asset markets the consequences of declining rates of return. All of this was the situation prior to COVID. I believe it explains the configuration and preoccupations of monetary and fiscal policymakers. Another way of stating or describing the structural changes that I just put forward is to suggest that there has been a generalized decline in the level of R star, the neutral real interest rate that has been felt in most major countries. Notice that, as I have pointed out in work with Jason Furman, as Olivier Blanchard has highlighted in his AEA presidential address, a world of low real interest rates is a world in which one has to think rather differently about fiscal policy. Perhaps the sharpest way to make the point is to ponder the Maastricht criteria. The celebrated Maastricht criteria, emphasizing 60% national debt to GDP ratios, 3% deficits, and so forth, were put forward in an era when the German nominal interest rate was 8 to 9%, and the German real interest rate over 10 years was in the range of 5%. Today, the German nominal interest rate is in the range of negative 30 basis points for 10 years, and the German 10-year real interest rate is below negative 1.5%. It is an immediate, proximate, and important topic for economic research to think about how appropriate debt sustainability criteria vary with changes in nominal and real interest rates. But it seems to me hard to escape the conclusion that there should be some such dependence. All of this was the situation as it stood prior to the traumas of COVID. It was my belief then that the policy problem, after a decade in most major countries of inflation below target, was less one of dynamic consistency and containing the urge to inflate, and more one of absorbing saving in a healthy way so as to maintain full employment, approach target inflation, and avoid the debilitatingly low interest rates that penalized savers, promoted leverage, and inflated asset prices with attendant risks to financial stability. Of course, for a time, COVID has changed everything. I shall talk about the United States, but the types of considerations that I am adducing are, I believe, applicable more broadly, though perhaps to a lesser extent than in the United States. COVID, of course, called forth a substantial adverse demand and an adverse supply shock. It is as if a certain share of the economy was simply closed. That led to less capacity to produce. That led to less demand as that section of the economy failed to generate income. It also led to significant financial disruption. The approach of the authorities was surely correct and important in maintaining and reasserting financial stability with extraordinarily aggressive central bank policies to maintain a measure of stability in asset markets and to backstop systemically important financial institutions. At the same time, motivated in part by supply-side considerations, the avoidance of the destruction of large numbers of businesses and an attendant reduction in economic potential, in part by social welfare concerns, the desire to avoid large numbers of people who found themselves without work, out of work and unable to spend, and in part by considerations of aggregate demand. The United States, and to a much lesser extent, but some extent, other countries embarked upon massive fiscal stimulus. The fiscal stimulus already legislated in the United States over the 18 months since COVID began has totaled 25%, a bit more than 25% of the GDP. This is stimulus at closer to a World War II level than the response to any previous recession. Just as fiscal stimulus associated with rearmament in the Second World War, for a time banished any talk of secular stagnation of the kind that was widely promulgated in the late 1930s. Today's issue in the United States, and increasingly in other parts of the world, is less one of insufficient demand for labor, insufficient demand for labor, and more one of insufficient supply. If one looks at vacancy rates, they are at record extraordinary levels in the United States. If one looks alternatively at quit rates, they too are at extraordinary levels, suggesting great tightness in the labor market. Of course, these features are somewhat unique to the United States, and they are features of the extraordinary fiscal stimulus in which we have engaged. To calibrate that fiscal stimulus in one way that I think is relevant, as of this January 2021, labor incomes in the United States were running about $30 billion a month below trend. The fiscal stimulus that we have supported has totaled about $200 billion a month. So with almost any significant multiplier, there is substantial risk of overheating. And it is indeed my belief that the bottlenecks we are seeing, the labor shortages that firms are reporting, represent an overheating that is likely to continue for some time, and that is likely to be cautionary for policymakers, should be cautionary for policymakers going forward, and should be cautionary in other countries as suggesting the need to avoid fiscal stimulus on the full scale that has been undertaken in the United States. It also suggests the desirability of making sure that any program of public investment on which we embark, and I believe such a program is very, very important, must be paid for contemporaneously with increases in revenue, must be carefully and rigorously designed so as to ensure maximum effectiveness of dollars spent in increasing the supply capacity of the economy, and critically, must be based on an honest and realistic accounting of future expenditures that are likely to be incurred because of legislation. What does all of this say for central banking going forward? It suggests, I think, that in the United States and in some other countries, it will be very important to maintain current norms associated with price stability. We are, I believe, at a risk unmatched since the late 1960s and 1970s of expectations becoming unanchored as central banks explain inflation in terms of a range of specific factors rather than diagnose an overall labor shortage as being a consequence of overall levels of demand. That's why I welcome the Fed's movements towards QE and believe that more restraint than is now priced into markets or Federal Reserve statements of intention is likely to be necessary. With prudent fiscal and monetary policies, we have a prospect, not a certainty, but a prospect of avoiding an overheating. But caution is in order. Experience suggests that it is very difficult to slow major economies without causing them to fall off and slide into economic downturn. And so a policy of excessive delay is a policy that runs the risk of having to hit brakes very hard with potentially serious consequences. Beyond the current moment, however, if fiscal policy returns to more normal settings, if monetary policy is successfully used to maintain control, I believe the global economy is likely again to face serious challenges associated with savings absorption. And it is here, I think, that the Bretton Woods system will need to have a crucial role. If the absorption of high levels of global savings is a continuing challenge, if real interest rates continue to suggest that on a risk-adjusted basis, the private return to capital investment is very low, then there is the prospect that there will be need to supplement demand. Some of that, of course, can be accomplished through increased budget deficits, but such budget deficits raise questions of sustainability for those who run them. They run questions of their impact on exchange rates and trade positions. The obvious response to a world of excess saving is global public investment. Global public investment in responding to the challenge of climate change, global public investment in making sure that we are protected against future COVID, or more generally, future pandemics, global public investment in addressing the large differentials that now exist in income levels. The great structural and social threat in our moment of a slowdown or an end to convergence between developing countries and industrial countries, between emerging and established markets, is an inadequate global response to COVID, is a fragility in the developing world revealed as interest rates rise in the industrial world. Were there to be substantial capital outflows on net from developing countries, it would be a tragedy in three ways. It would be a tragedy in terms of what it meant for the immediate livelihoods of people in those countries. It would be a tragedy in terms of the far greater difficulty we had in addressing global challenges like pandemic, like climate change. And it would be a great complexifier of the macroeconomic challenges of maintaining full employment with low inflation. And so it seems to me that the work of a reinventing Bretton Woods committee, of thinking about central banking on a global scale, has never been more important than right now in a world profoundly altered by low global real interest rates and currently profoundly altered by the dynamics of COVID. Planning for Bretton Woods took place while the Second World War was still being fought. Planning for the post-COVID era needs to be beginning now if the global financial system is to do its part for the global's peoples. Thank you very, very much.
Thank you, Dr. Summers. Ladies and gentlemen, allow me to welcome once again Dr. Eli Remolona, who will be the moderator for the question and answer portion. Dr. Remolona, you have the virtual floor.
Good morning, Professor Summers.
Good morning.
honor for me to share the screen with you. It's an honor for me to help you field questions from the floor or screen questions from the floor. I hope that's okay.
Absolutely.
Maybe I should start with the first question. You suggested that in this world of low interest rates, both real and nominal, there is a shift from action in the labor market and the goods market to more action in the asset market. Is that, do I read that right?
Mm-hmm.
And you suggested that this would change the way central banks operate. You said that they should still pay attention to price stability, but maybe there will be more risks about financial stability. Does that mean also that they will need to emphasize other tools besides the usual policy rate, the usual tools based on interest rates? Would they be using asset purchases more? Would they be using these other things that they have been developed in the midst of crisis? Is that the way you think monetary policy will evolve in response to this long-term shift?
I think you've raised an important question. Yes, I think in general, as the number of objectives increase, the number of instruments that central banks use has to increase. So I think that will be the tendency. I think that a world of lower interest rates will be a world of higher multiples, higher asset prices, greater leverage, and therefore financial stability concerns will be more important. I'm not sure that the right tool for responding to that will be QE outside of emergencies. I'm rather skeptical of QE outside of emergencies like those that took place in the spring of 2020. If you think about it, QE is a kind of terming in of a country's national debt. So when the Fed issues reserves, which are a kind of floating rate debt, in order to buy medium-term government bonds, it's doing something that is reducing the maturity of our debt. Reducing debt maturities at a time of extraordinarily low long-term rates and extraordinarily high uncertainty seems to me to be an odd national strategy. So I'm not very enthusiastic about QE as a strategy outside of moments when there's tremendous market instability, and that instability needs to be contained. I would rather put emphasis on regulatory tools. And I think the most important financial stability arena today is in part addressing issues at the large financial institutions. But I believe that the changes that have been made have brought considerable progress in that area. And my greater concerns today would lie with the shadow financial system, that system that lies outside of major banks, where I believe there remains very substantial potential for instability. And so it seems to me that shadow financial system is the appropriate policy priority going forward.
Thank you, Larry. We have questions from the floor. Let me try to. Here's a question from Bill English. You said the current inflation is due to overheating. I'm just reading from the chat, Professor Summers. Isn't there more labor market slack to be absorbed? Would overheating call for the Fed to move quickly to tighten monetary policy? Is that what you think? How far and how quickly? Do you worry about the combination of tighter monetary policy and the end of much of the fiscal expansion program? Will this cause a sharp decline in activity over the next year or so? How do you assess that risk, particularly given the risk that a significant slowing could slide into a recession?
Bill, thank you for posing two important issues. You raised the question of a excessive contraction in the economy, and you raised the question of the current degree of slack. The evidence for the United States, where I think you're the context in which I think you're asking the question, suggests that there's a very substantial outward shift in the beverage curve. Labor market indicators derived from the level of employment suggest some considerable slack. Labor market indicators derived from the employer side of the labor market, what's happening with quits or what's happening with vacancies, suggests remarkably little slack. My own read is that there's at least as much information in the latter set of indicators as there are in the former set of indicators. COVID has disrupted traditional labor supply patterns. The sets of benefits introduced after COVID, the set of income supports to households, all of this has probably had a meaningful effect on labor supply, and I'm not sure we can rely on those effects diminishing quickly. I would rather look at the behavior of output, which has now essentially attained previous trend levels and is forecast to run above trend levels. I would rather look at the behavior of disposable income, which is now running way above previous trend levels in forming a judgment. So I don't think we're looking at much slack now, and I think looking at the employment ratio is misleading. On the question of withdrawal of fiscal stimulus, I think it's important to go back to the kind of figures that I cited about $200 billion a month of stimulus having been provided against a $30 billion labor income gap. The evidence, I believe, suggests overwhelmingly that a large fraction of the fiscal stimulus that was provided in 2020 and early 2021 has been saved. The level of household cash balances, for example, in bank accounts, is running at extraordinary levels. There's very, very little evidence of distress in credit. If anything, people are paying their car loans better, paying their credit card bills more regularly than they have on a historical basis. All of that, it suggests to me that this fiscal stimulus that we have received is going to be rather longer acting than some traditional modes of thought would suggest. And so I believe that demand is likely to be quite robust and very robust relative to supply headed into 2022. What is the right pace? I think that's something where it will depend upon the feel that the economy has. In general, I would like to have seen tapering of QE begun already. I would be more comfortable with tapering taking place over 6 months than over 9 months. And mine certainly would have been a 2022 dot if I had been in a position to provide a dot.
Thank you. Thank you, Larry. The tapering that we're seeing right now seems to be tapering without the tantrum. So that should be reassuring, shouldn't it?
I believe so. In fairness to those with other views, we have not yet begun the actual process of tapering, and perhaps what have seemed to me to be excessive delay and excessive statements about planning to plan and so forth for tapering, perhaps that's the reason we have avoided a taper tantrum. And it is easier, I am very much aware as an observer, to call for bold changes in policy than it is to actually implement policy changes boldly. And so I think a certain gingerness in the step of policymakers can often be appropriate.
And some care in communication, maybe.
Certainly.
I'm still waiting for other questions from the floor, but let me make a comment on what you have said. I found very reassuring your suggestion that in responding to excess savings, we now have an opportunity for a bigger public investment, especially for climate change, public investment also for maybe for income inequality. Can you elaborate on that? Is there a mechanism? Is there a process that would be good for figuring out what to invest in? Do we just go with the Paris Agreement? Do we just go with the existing agreements?
I think first, it's just to emphasize that the social return on promotion of innovation, for example, with respect to climate change, or the social return, for example, with respect to being in a position to deliver vaccines even 1 week faster than we did last time, is immense. And it is the challenge of financial intermediation to channel saving to the highest value uses. Seems to me that we need to be rethinking the architecture of our international financial institutions in that regard. I commend Kristalina Georgieva on the SDR allocation and on the ambition of IMF plans to restore the to reallocate SDRs so as to promote increased investment in resilience. I feel that there should be a goal. I don't know what the goal is, but perhaps over the next 4 years to double the lending capacity of the multilateral development bank system. That it seems to me that there is a moment of immense importance in supporting investments relating to health and climate resilience, where the development banks should be operating with much more ambition to provide low-cost funding to those who are embarking on large-scale investment programs. And so I think as a start, the World Bank's formal name ought to become the International Bank for Reconstruction and Sustainable Development, so as to highlight the importance of green investments. It seems to me more generally that it is appropriate for all who are involved in providing finance to the developing world to ponder the implications of their finance both with respect to climate and with respect to health. Because I believe that at a moment where we're going to want more investment, these are for aggregate demand reasons. These are the highest return investments available.
Socially, highest return socially.
Yes.
I'm being told that we're out of time, but Larry, this has been wonderful.
It has been a great pleasure to be with you.
Thank
It has been a great pleasure to be with the Reinventing Bretton Woods Committee, and I hope at some point to have the opportunity to be with many of you in person. Thank you very, very much.
Thank you very much.
Bye-bye.
Bye.